Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. Imagine for a moment that the day has come. The day you've been waiting for, perhaps for years. After a long and grueling fight, the price of silver is finally free. It has broken through $100, then $150. Your portfolio is showing life-changing gains. You did everything right. You were patient. You won. You take a portion of your precious, now incredibly valuable coins, and you walk to your local dealer. Not to sell everything, but just to lock in some profits. Maybe to buy a car or make a down payment on a house. You walk in, ready for your victory lap. But instead of congratulations, you see a look of distress on the dealer's face. And you hear a phrase that seems absurd, impossible. Sorry, we're not buying today. You're confused. You go to another dealer, the same answer, a third, the same. Suddenly you realize you're in a strange nightmare. You are rich on paper, but powerless in reality. You are holding the key to a treasure chest, only to discover that all the locks in town have vanished. You are on New Era Economics. Today we are investigating one of the biggest and most dangerous misconceptions in the world of physical metal investing. The myth of guaranteed liquidity. Subscribe to learn more. Our investigation is just getting started. This seemingly illogical scenario, where you cannot sell the world's most in-demand asset, is not a fantasy. As my investigation will show, it is the most likely and most dangerous consequence of a true market squeeze. We will dissect the fragile market mechanics that everyone relies on and show why they are designed to break at the most critical moment. But most importantly, we will understand how to think strategically to avoid falling into this trap. To understand why a dealer might refuse to buy from you, my investigation led me to dissect the very nature of their business. We've grown accustomed to thinking of precious metal dealers as a kind of ATM. You insert metal, you get cash. But this is a dangerous misconception. In truth, a dealer's business is not just about buying and selling. It is a complex logistical mechanism that can only function under conditions of relative stability. I've identified 3 pillars that this entire system rests upon. And in a true crisis, all 3 pillars collapse simultaneously. The first pillar is a two-way market. A dealer makes money not on the price going up, but on the spread, the small difference between their buy price and their sell price. For this business to work, they need both buyers and sellers in roughly equal measure. He buys coins from one client and, in short order, sells them to another. This allows him to constantly turn over his capital. But what happens when, on a single day, 100 people walk in wanting to sell, and not a single person wants to buy? Or, the reverse, 100 buyers and no sellers? The balance is broken, and his business model shatters. The second pillar is a functioning supply chain. A dealer is not an island. He is just one small link in a long chain that stretches back to wholesalers, vaults, and ultimately, to the refiners and mints. He must be confident that he can quickly sell his excess inventory to a wholesaler, or conversely, quickly restock if demand surges. This chain runs like clockwork, in peacetime. But as we will see, during a squeeze, this chain snaps at the very top. And the third, most crucial pillar, is a stable banking system. A dealer needs constant access to large amounts of cash to buy back metal from clients. He needs functioning wire transfer systems. He needs confidence that the cash he receives will hold its value. During a true systemic financial crisis, the very event we prepare for by buying silver, all of these guarantees evaporate. So, what conclusion did I reach? We are used to thinking of dealers as a fortress. My investigation revealed that they are merely a fragile outpost, standing on the front lines. And during a real storm, that outpost is the first to be overrun. You think this is fantasy? My investigation shows that the first cracks in this system are already visible today, even in relatively calm times. Right now, dealers all over the world are becoming increasingly reluctant to buy back silver from the public. They are offering prices $5 or even $10 below the market rate. They are imposing limits on buyback volumes. Some are simply pausing their buyback of certain products. What is now a quiet whisper and an inconvenience will, in a moment of true crisis, become a deafening shout of no and a closed door. So, we see the first signs of the system fraying. But to understand why, in a moment of a true squeeze, polite inconveniences will turn into total paralysis, we need to conduct a post-mortem of this future crisis. My investigation has identified 4 stages of supply chain collapse that will lead to a complete freeze of the buyback market. The first, and most important fundamental reason, is paralysis at the very top. The entire metal resale system will break long before you ever get to your dealer. Think about it. What does a dealer do with the coins he buys back from you? He can't just put them on a shelf. He must sell them to a wholesaler, who in turn sells them to a refinery. The refinery melts down those coins and old scrap into 1,000-ounce industrial bars to sell to Samsung or a solar panel manufacturer. But under conditions of wild volatility, where the price of silver can soar by $20 in the morning and fall by $15 by evening, the refinery's business becomes impossible. They cannot hedge their price risk on the futures market because that market itself will be in chaos. Buying scrap at one price in the morning could turn into a catastrophic loss by the evening. And so, they will do the only rational thing. They will stop operating. They will cease all buybacks of any metal until the situation stabilizes. The supply chain will snap at the highest industrial level. Your dealer will be the last to know. When that happens, we will see 3 swift and inevitable consequences at the retail level. The second reason is operational chaos. The dealer, who can no longer sell the metal he buys from you up the chain, will instantly cease all buybacks. His sole focus will become selling whatever inventory he has left in stock. We will see a picture familiar from any panic. Empty shelves. Out of stock will be plastered all over websites. But there will be something new, something paradoxical. An inversion will occur. Ordinary people looking to sell and lock in their profits will discover that the dealers, the very people who are supposed to be the buyers, have themselves become sellers of their remaining stock, competing with them. The third reason is a collapse of trust. When an ounce of silver is worth $200, the temptation to create a high-quality silver-plated tungsten fake will be immense. A dealer, besieged by dozens of panicked customers, will have neither the time nor the expensive equipment to test every single coin. The risk of buying one single fake and losing thousands of dollars will outweigh any potential profit from a buyback. The safest move for him is to not buy from anyone at all. And the fourth reason is a liquidity crisis. During a systemic financial crisis, when banks might limit or even freeze cash withdrawals, the dealer simply won't have the physical cash to buy your metal. Imagine you bring him $50,000 worth of silver. Where is he going to get that kind of cash if the country is on a bank holiday? He won't be able to. This is the anatomy of the freeze. It is not a malicious conspiracy by dealers. It is the logical and inevitable collapse of a fragile system under the weight of extreme volatility and panic. The chain breaks at the top, and that break cascades all the way down, leaving the retail investor with their treasure that nobody wants to buy. So, the picture my investigation paints is grim. The physical silver market freezes, leaving investors with an illiquid asset. But here, I discovered something even more disturbing. This problem, this trap, is not limited to those who hold physical metal. It is much, much broader. It applies to everyone who thinks their wealth is safe within the digital system. Let's imagine another investor. He was smarter, or so he thought. Instead of dealing with heavy, inconvenient bars, he invested in the stocks of silver mining companies, or in a silver ETF. His brokerage account shows a $1 million profit. He too is a winner. He opens his trading terminal to sell his shares and lock in that profit. But what he sees on the screen is a message. Trading on the stock exchange has been temporarily halted due to extreme volatility. In moments of true systemic crisis, the authorities do what they have always done throughout history. They change the rules to save the system, not you. They can declare bank holidays for days or even weeks. They can freeze trading on certain stocks or entire sectors. It happened with GameStop. It happened with nickel on the London Metal Exchange, and it will undoubtedly happen again on a much larger scale. Or perhaps the market is open. Our investor hits the sell button, and nothing happens. There is simply no bid in the market. There are no buyers. Everyone wants to sell, but no one wants to buy. His shares, which were worth $1 million a second ago, are now worthless because they cannot be sold. Or a third scenario. He manages to sell. $1 million in cash appears in his account. But on that same day, his brokerage firm declares bankruptcy, as Lehman Brothers did in 2008. And his cash is now trapped in a multi-year bankruptcy proceeding, from which he might only recover pennies on the dollar. What conclusion does this lead us to? Both the owner of the physical coin and the owner of the stock in a brokerage account face the same fundamental problem, which I call the paper profit trap. You suddenly realize that wealth is not the numbers on a screen. The numbers are just promises. Wealth is real assets that you can use or exchange for other real assets and goods, bypassing the broken financial system. The problem for our investor with the physical silver is not that his asset lost its value. On the contrary, it has become priceless. His problem is that he was trying to trade it for depreciating paper money inside a system that is in a state of collapse. He was trying to play by the old rules in a game where the rules have changed. And this brings us to the most important conclusion of our investigation. So, what conclusion has our investigation led us to? It has led us to the realization that in a moment of true systemic crisis, liquidity is an illusion. The doors you planned to exit through will slam shut at the very moment you need them most. This is a frightening thought. But understanding this trap is the very first step to avoiding it. The main takeaway from my research is the need for a paradigm shift in our thinking. The problem is not, at what price will I sell my silver? The problem is, why would I sell a real, tangible asset in exchange for the depreciating paper currency of a system that has just proven itself insolvent? This brings us to a key idea. In the moment of the freeze, two markets will emerge. The first is the official paper market. Some numbers will be flashing on the screens, maybe $50, maybe $200. But these numbers will be meaningless, because conducting a real transaction at that price will be impossible. It will be a ghost market, and simultaneously, a second, real street market will appear. This will be a market of direct exchange, of barter, a market where value is determined not by numbers on a screen, but by real-world utility. In this market, an ounce of silver won't be worth X number of dollars. It will be worth a bag of potatoes, or a full tank of gasoline, or a month's rent, or a share in a local, functioning business. Understanding this changes the strategy completely. Your goal is not to time the top to sell for dollars. Your goal is to use your silver as a lifeboat to cross from a sinking financial system to the new economy that will emerge on the other side. Your goal is to swap, not sell. Don't think, who will I sell my silver to? Think, what can I exchange my silver for when dollars are no longer desired? This shift in thinking is your ultimate solution. History shows that in every crisis, wealth is not destroyed. It is simply transferred. It moves from those who held promises to those who held reality. Understanding the liquidity trap is what separates a prepared investor from a future victim. If this investigation has made you rethink your strategy, subscribe. In our next videos, we will continue to explore the strategic thinking required to navigate the new economic era.